Good morning, everyone, bright and early. Welcome. My name is George Hoguet, and I'm board chair of CFA Society Boston. I'd like to welcome everyone to this conference on China from the inside and the outside. And I'd like to thank everyone who worked so hard to enable this conference, particularly Connie Everson here on the stage, Amy Pepe and Stephanie Field of the CFA Society Boston staff, and of course, most importantly, our panelists, some of whom who've flown all the way from China and got here late last night. In nominal GDP terms, China is now the world's second largest economy, and by some estimates, it will be the world's largest economy by 2035. Since the global financial crisis, China has accounted for roughly 30% of the growth in the world economy. China increasingly impacts the world economy through multiple channels. To name just a few, the trade and commodity channel, the exchange rate and monetary transmission channel, the global investment channel, particularly through its sovereign wealth funds and Asian Infrastructure and Investment Bank, the global environmental channel, and the emerging market policy coordination channel. Many economies in Asia are now more sensitive to developments in China than the United States. According to a recent IMF paper, a 1 percentage point permanent negative GDP shock in China would reduce world growth by 23 basis points in the short run. At Davos earlier this year, Chinese President Xi Jinping said, "The global economy is a big ocean and you cannot escape from it. Any attempt to cut off the flow of capital, technology, products, industries, and people among economies and channel the waters in the ocean back into isolated lakes and creeks is simply not possible." The Chinese stock and bond markets are among the world's largest and over time will provide multiple opportunities for global investors. For example, China currently represents about 27% of the MSCI float-adjusted emerging markets index, and this percentage could rise to 42% as A shares are gradually added. And of course, Chinese companies and Chinese-related companies listed in Hong Kong and elsewhere offer a very rich opportunity set. China's bond market is now the world's third largest and rapidly developing. RMB-denominated instruments account for about 1% of the world's global foreign exchange reserves of about 5.5 trillion, and this percentage is likely to grow. Further, economic theory would suggest that long-term real bond yields in China should be higher than in the developed world. So just by way of comparison, local currency 10-year bond yields now stand at about 3.65% in China, 2.21% in the US, and just 0.05% in Japan. So the gradual liberalization of China's capital account and RMB internationalization are likely to be some of the most profound developments in global capital markets over the next 10 years, although it's certainly true that these developments have proceeded in fits and starts. And of course, it remains an open question whether China can avoid a debt liquidation-induced slowdown in the coming years. Recently, the Chinese yield curve inverted for a while, and Moody's downgraded China's external debt from AA3 to A1. But if you look at Bloomberg up on the Outlook page, consensus comprised of more than 50 estimates holds that the Chinese economy will grow in excess of 6% in the next 3 years. So the future trajectory of the Chinese economy and the RMB remains one of the most hotly debated issues in global finance. And in this context, the perspective of investors inside China and outside China may differ. I'd like to welcome again our expert panelists who will discuss the current state of the Chinese economy and capital markets. Thanks to the good offices of CFA Charlottesville, a video recording of this session will be available to CFA societies worldwide. CFA Society Boston is very pleased to have an opportunity to arrange this event, and we look forward to strengthening the dialogue with local CFA societies in China in the years to come, and to address common problems and to better understand the ever-changing rewards and risks of investing in China. So thanks very much, and I'd now like to turn it over to Connie Everson of Capital Markets Outlook Group, and have her introduce our first panel. Thank you, Connie.
Hello, good morning, everyone. I'm Connie Everson. I'm a member of the program committee. We could spend several full days on macro subjects in the banking system. For today, we chose a particular set of topics, but we look forward to further conversations. And our aim for each panel today was to have a speaker who is China-based and one who is US-based for an exchange of perspectives. In fact, on this panel, each speaker contains an exchange of perspectives. Our speakers are Qian Wang, who is visiting from China, but has worked in the US, and Tom Quarmby, who is based here, but has worked in Hong Kong. Tom is just on his way. In Qian's case, she has a master's degree from Columbia and worked for Credit Suisse and Goldman Sachs in New York. In her current role, she is Senior Vice President of the Bank of Qindao, General Manager of Sales and Trading. And in that capacity, she manages the bank's own capital and oversees interbank trading and asset management. The combined portfolio is approximately $40 billion US dollars. Now, Tom worked for Barclays and Deutsche Bank in Hong Kong and the Macquarie Group in his native Sydney, Australia, before returning here. He's equity analyst for Fidelity Investments and a specialist particularly in China bank shares. So each speaker themselves can draw on multiple perspectives for this very multiple-sided subject. So Qian will speak first on the odd-numbered subjects, followed by an optional comment by Tom, and then we'll reverse that order for the even-numbered subjects. So Qian, thank you. Subject number one is yours. Thank you.
Hi, everyone, because I'm going to use the PPT slides, so I'm going to stand here, so a little bit weird from distance. A great honor to be here. Thank you for inviting me here. I think I'm the speaker who flew for the longest time to be here, 16 hours. So hopefully we're going to have some fireworks today. I work in the industry doing investment decision on a daily basis. So I talk mainly from a practitioner standpoint of view, not from research. So if you do have different views, welcome to come to me after the event. We can talk offline. I really want to hear those voices as well. So going to the first topic. Let me skip those. Actually, how is the financial industry in China? Who are the players? What are they investing? And I also want to share a few significant facts about banking industry in China. First of all, I would like to know banks actually dominate the investment management industry in China. If you look at the asset size of the different types of financial institutions, banks' asset size is almost as a dozen as of the second largest type, trust, and a dozen of private funds and mutual funds together. Usually, trust mostly does project financing, which we call it a non-standard debt financing in China. And if you rank the buy-side institutions by impact, top one is bank without any doubt. Second would be the insurance company, and then mutual fund. But it has bigger and bigger portion of their the mutual fund money from bank and PWM of bank. Actually, mutual funds are more like the buy-side firms here in the States. Mutual funds, pension funds, hedge funds, which are the typical buy-side firms here. If you look at their capabilities from different aspects, you can see actually banks are still connecting dots in the industry. They own the resource, including funding, channels, brands. They even have government backup. They kind of own government credit to a certain extent in China. Security firms have mid-level of brand and channels while good at portfolio management. Mutual funds are like an amplified version of security firms, which are the best at portfolio management. The ultimate cause of that is the compensation system, of course. Trust is like an opposite version of banks, except they are both bad at portfolio management, I mean, in this ranking. And insurance companies are surviving well with mid-level of portfolio management skill and good product design and investment tools. In this case, banks are under very strong regulation with the most restrictions to operation in the operation of their business. I'll just go through this page quickly for time's sake. So looking at the US buy-side investors' peers, mutual funds in China, you may wonder who are investing in the largest portion, money market fund. I would say they're banks. And stock fund takes up only by less than 8% in this case. So I would say financial institutions in China focus largely in fixed income. Actually, the size of bond market of China is 130 trillion RMB. Because banks' proprietary fund, the major player bank, their proprietary fund is not permitted to invest in equity market. They have the same habit in doing private wealth management as well. And for insurance company, they are only allowed to invest in equity up to 30%. It is a regulatory requirement. And in equity market, institutional client investors hold only 15% of that market value. So if you look at China's fixed income market, which is a pretty large one, I would ask you to pay attention to their risk preference, because the risk preference of all institutions are generally very low. The first default case didn't happen until March 2014, which is only 3 years ago. So only a few private equity funds and security companies are focusing on high yield strategy, which is very common here in the States, but really rare in China. You also want to know there's a deteriorating credit environment going on in China's market. In the past May, actually the rate hiked. It's for some names even hiked above 10%. So I would say these factors, for example, liquidity freeze, tightening funding in real economy, and the lower growth rate in many fields, those all accumulated very high credit risk in the system. So not after long, maybe this year, there will be more names going default. So let's avoid those, wait and see. A few facts about the banking industry. Banks used to be traditional, but in China, a big portion of liabilities is not now from deposit anymore, but from interbank funding. If you look at the charts, the blue bars are the character's too small. It's interbank liability over total liability. There is a cap required by the regulatory authorities, which is 33% of total liability, but still the ratio is high. So large state-owned banks get funding from central bank, and then they lend it to smaller bank than to non-bank institutions. Yes, there's a phrase called non-bank institutions in China, even for that. So that's why now banking system is highly depending on the regulatory authorities. The biggest boss is now People's Bank of China, and we call it central bank mom now in the market. It's the similar situation on asset size of banks. Loans only now take up 60% of banks' assets. It's a much lower ratio than you expected for traditional banks. All right, to save some time for Tom, I'll stop here on this topic. So basically 3 keywords: bank, fixed income, and challenging tradition. All right.
I'll stay seated. We can continue the discussion. Sure. I think from my perspective as a banker analyst and a researcher of banks for almost 20 years now, when I first started looking at the Chinese bank sector back in 2003, I mean, it looked like a disaster at that point in time and was quickly recapitalized. But I think what I've seen over the past 14, 15 years or so is, I think particularly from a regulatory standpoint, is a fairly conservative approach by the regulators to ensure that the banking system remains fairly healthy and robust. A lot of what has been proposed through Basel II, Basel III, and potentially Basel IV were regulations that were in different shapes or forms already imposed by the Chinese regulators more than 10 years ago, including counter-cyclical provision buffers, lower liquidity ceilings, or the loan-to-deposit ratio cap. And I think these are now when we're seeing flavors of this kind of regulation now coming through in developed countries as well, where the financial crisis obviously highlighted a lot of problems. I think for the banking system in China as well, and the overall financial system, one of the things I always try to remember is that whilst there is a large unofficial banking or financial system in China, it was unfortunately given the name of a shadow market many years ago, rather than what it really is, which is just an informal capital market. So in the US and a lot of developed nations, we're widely accepting of private equity, venture capital, angel investors, even P2P lending now. But in China, we give that a tarnished name of shadow banking and unofficial institutions, albeit that the mechanisms are quite similar. I think as well in China, we look at debt levels for the banking system and consider them to be quite high. But then we look at government debt levels and find them quite low. Local government debt levels high, but within the banking balance sheets. And that is a function of the immature nature of the payment system and the overall capital markets in China. So I personally remain I always use the term constructive when it comes to looking at the Chinese banking system and when it comes to investing in Chinese banking shares, in the sense that on the one hand, yes, there is much reform to be done for the Chinese banks and a lot of cleanup of existing loans. On the other hand, there's plenty of time to do it. Liquidity levels in the system are extremely healthy. The reform and development of the domestic capital markets, particularly the debt capital market, will allow a lot of terming out of existing debt and removal of debt from bank balance sheets, which will have challenges along the way, but I think will lead to an overall favorable outcome for the Chinese economy, in that it will continue to sustain the kind of 6 or 7% growth that our opening speaker addressed. And I think that's key in that we see China as an emerging market, one that is undertaking its own reforms rather than sort of IMF-instituted reforms such as most of Asia had to do in the late 90s. It's undertaking its own reforms at a period where it's still achieving nominal GDP growth of 7 or 8%. And to be able to reform and in an environment where there is growth, I think is going to lead to far more favorable outcomes than I think some investors have priced, which look more like traditional emerging market valuations for Chinese banks.
Let's move to monetary policy. And another item on the list was, is monetary tightening underway, and do authorities have a choice?
I think I'll skip some of the slides about the regulatory. One thing to mention quickly is the shadow banking that Tom just mentioned. Actually, in China, there are 3 shadow banks getting attention. The top three, which is bank, private wealth management, trust and trust, and interbank funding investment. So any asset liability pair besides traditional banking business. So we'll skip the private wealth management part, or go to the monetary.
You know, do you have a minute or so on wealth management? It's so important. I was looking at my watch, but let's spend a little bit of time on that wealth management.
I'll just go through quickly to give you some facts about.
Good idea.
All right. So this might be an interesting topic, private wealth management in China. It got attention from both domestic and overseas market. So it is growing dramatically, I should say. In 2014, the size of China's banks PWM was 15 trillion RMB. During 2 years, the size has been almost doubled, which is 29 trillion now. But the interesting part is PWM in China is totally different from what we understand here in the States. If you look at the stats of two types of products, net asset value type and expected return type, in the States, they are most net asset value type, but in China, almost all the products are expected return products. It means the customers get return as expected. The rigid payment has been violated so far in the market, yeah. So it is like another balance sheet of a bank. It is like deposit to customers with a higher rate, which is why we call it shadow banking. So banks PWM in China is almost 1 to 5 as deposit. Considering bank size, it is a surprisingly large number, 29 trillion. Remember the size of private fund, public fund, and security companies in China together, the asset size is 25 trillion. So it's even bigger than the three together. So for different types of banks, the ratio of their PWM to their deposits are different. I would say the second-tier national banks and the regional banks are the most active in PWM field. If you look at the asset allocation, PWM inherited banks' risk appetite, so most of them are in fixed income, also because they are expected return type of products. I would speak quickly. And if you look at the buyer's distribution, individuals are still taking the largest proportion, but you want to pay attention to interbank PWM. They are getting more and more in this distribution, and it is more like interbank lending with a higher rate. It is not really like PWM, as you understand. All right, I went this through quickly, and we're going to the tightening monetary policy.
Yes, Tom, would you like to add a comment on wealth management products?
No, I just go back to my earlier comments. It certainly is a large part of the Chinese savings market, and I think that is, I think, probably more an opportunity going forward. As was mentioned, that there hasn't been any large-scale default on private wealth management products, particularly in this low-interest environment and low guarantee return for life insurance product environment. The wealth management products are proving a more favourable savings alternative for many savers and investors. But I think as you continue to see reform around the wealth management product market, you continue to see the development of debt capital markets, more importantly, which will allow sort of longer duration investments rather than these short-term wealth management products with higher yield relative to the spot deposit rate. So as the yield curve steepens in this rising environment, which we're about to talk about, I think you will see a shift in wealth management assets away from this, perceived higher risk, short-dated products towards either more life insurance assets and potentially into bank term deposits as well.
And monetary tight.
We were talking about this last night a little bit. So is monetary tightening underway? Let me begin with the fact. Yes, it is. Actually, there's the liquidity tightening almost in a sudden way happened end of last year. So when you review the market during the time period, it is totally from what you were feeling, experienced the market. There were a lot of kiosks at that time. The borrowing rate rose to 2.8%, up about 70 bips. And also, on certain days, the 7-day bond repurchase rate rose to 12%, which is, at that time, some small banks, they went default on their money market borrowing, or they was not able to keep enough deposit reserve. That's a big deal in China in the regulatory system. And also, another sign is from October 20th to May 10th this year, yields on 10-year government bond spiked 99 bips. It's now 3.64, which is the risk-free rate. And also, the yield on 10-year CDB bond, which is China Development Bank, it jumped to about 4.4%, which is also considered like a risk-free rate in China. Think about it, it's a really high yield. Well, to understand whether the tightening is going on, I want to summarize the causes of the liquidity shortage from December 2006 first. The first reason is People's Bank of China did so on purpose, because there was too much liquidity. There was big space for funding arbitrage. You borrow money at 2%, and you find some liquid asset easily at 4%. So the institutions just raise their leverage, raise their risk appetite, ignore liquidity risk management. So central bank mom punished her kids. So they tightened the liquidity in the market. The second reason would be fundamental, because the economy remains stable with inflation expectation up. So there's space for that. And also, we are talking about deleveraging all the time now in China's financial markets, because there's the leverage too high now. I believe the bank's asset to GDP ratio in China now is 300%, which in the States is only 100%. That's a huge difference. So the third reason is to deleverage. And also the fourth reason is external, because rates hikes in the US as well, and there's capital outflow from China to outside. And finally, would be the trigger. It's like a few events in credit market from some non-banking institutions. They broke the confidence of the market. So here's come the rate spike in the market at that time. So do regulatory authorities have a choice? It's the same question as, is monetary tightening going on? I would say they focused on deleveraging in the first quarter and second quarter. Actually, I forecasted this at the beginning of this year during the training courses to NAFMI, and it did happen. But in the second half of the year, if the economy gets worse, I think monetary easing can be expected, because central bank would not proceed deleveraging without considering consequences, right? So if you look at the influential factors on fixed income, which is totally about the interest rate, I would say the economic growth might turn slower, which is the bull factor. Also, central bank will keep liquidity stable. It's not doing that without considering consequences, right? And also, the confidence on the market actually picked up gradually. But on the bear side, the external factors are still bear, because I think the Fed rate might pick up as we expected. And also, there's still weak confidence in the market, and the liquidity, we cannot expect those to be really loose as in the past few years. So the conclusion, I would say, I'm cautiously optimistic in the long term due to the bull-bear factors that I mentioned, but still I cannot expect strong bull market. I would say it's going to be a bumpy market in short term.
Yeah, I think in terms of monetary policy, I think a message I'd like to send out is I think you can kind of think of the monetary policy mechanism in China and those in the West as kind of converging. So what China had to do 5 years ago to control liquidity and interest rates and capital flows was control a large number of mechanisms. So you had reserve ratio requirements, you had the capital controls themselves, specific controls on lending to certain industries, loan to deposit ratios in the banks, and then you had interest rates as another mechanism outside of that, along with then moving the currency and hence that China is often viewed as a currency manipulator. I think over the last couple of years, what we've seen is that with various regulatory changes that have been made through the financial sector, through the banking system, the insurance sector, changes that have been made in terms of the ability for Chinese companies to borrow offshore or onshore and undertake currency arbitrage as they were so aggressively in sort of 2010 and 2011. Regulations have changed the ability to do that. And that means the monetary policy mechanism is becoming more effective in China. And so we'll see that control over interest rates be more of a useful tool in controlling growth, capital flows, and ultimately the currency in China compared to what we had seen before. I remember speaking to one of the larger Hong Kong banks in 2000, I think it was late 2010. And I said to them, you've been doing a lot more property lending, your balance sheet's full of property loans, shouldn't you be diversifying a bit? And the CFO said to me, well, yeah, we think we're going to focus on arbitrage lending for a while. And I almost fell off my chair. I was like, even if it's cross-border, letters of credit exchanging with Chinese companies, US dollar for RMB, deposits in your mainland bank, I don't think you should be going out and talking about arbitrage lending as a strategic focus for this institution. But lo and behold, it was, and it was something we saw in huge waves in Hong Kong and from Chinese companies. And I don't think we'll see a repeat of that because the dynamics between the dollar rates and renminbi rates have changed. And as I said, there's a lot more regulation in place that will ensure that kind of activity doesn't take place again. So that's my message today. I think when we think about monetary policy, is that you've got to remember that Chinese monetary policy, even 12 months ago, is very different to what it is today, and it will be heading, and converging to what we accept in the developed world. And again, in the US, for example, or in Australia, where we talked about monetary policy as a blunt tool, that was recognized by many central banks, and they too have been developing their mechanism, whether it be through various open market operations or quantitative easing or tightening, as the case may be. We've seen that developed market central banks have also expanded the scope of their involvement in money markets. And I think China will continue to reform and change the way it does things as well.
And Tom, your topic next was what should investors expect of the renminbi?
Well, I think to my last comments, I think you can expect the renminbi to start to behave more normally. I think the internationalization exercise that began with the CNH in Hong Kong has been fairly successful in that it took a lot of the initial speculation out of the market. When we look at what's happening in property markets around the world, we know there is large outflow of at least personal and some corporate capital from China into other currencies around the world, and that has potential for repatriation or not. But it is a gradual opening of the capital account. So my outlook for the RMB, I mean, when I first visited China in 1990, and then 93, I lived there 94, 95. I mean, I vaguely remember the currency as, I think initially there was the two currencies, the foreign exchange currency, which had a wonderful black market rate, and then there was the renminbi, which only locals the locals had access to, and the foreign exchange currency was for foreigners and for buying foreign goods. And I mean, exchange rate I think was 4, and then I went back and it was 8 to the US dollar, and then it was 6, and so I think the days where we see that kind of volatility are behind us. You start to see the renminbi behaving more normally. I don't think it should necessarily on its own against global weighted currencies strengthen a great deal from this point. I think China should be tightening, but very, very gradually. And compared to the settings for monetary policy in China compared to the West, I think obviously the West has more to do in terms of tightening, which would mean I think the RMB sort of remains fairly stable, maybe even slightly softer from this point.
I do agree, actually. Last year, we see RMB fell by 6.5%, which is a large number it's the largest since 1994. And I didn't see RMB would depreciate by that large again either, because People's Bank of China and SAFE, they're taking active actions. So outbound direct investment, I think, fell by 64%. And also the net sales of FX actually dropped to 40 billion by 70%, which is a large number. Means it's getting stable. Yeah.
Our final subject had to do with the economic outlook. So, John's question for you, are the GDP and GDP growth rate driven by property prices or overshadowed by other things?
Great, that's an interesting question, actually. Let me brought up this. First, actually, I've been asked all the time, do you believe in GDP numbers? Well, I would say no before, because I did hear rumors that from the local statistical bureau, they tortured numbers. So when it's summed up, there will be some like it's not reflecting the real economy. But I would say yes to a certain degree now, because if you look at the 3 secondary industry index in the chart, 2 of them are actually Qian index, the power generation index and the rail freight volume index. They are fairly correlated to GDP growth, actually. And if you look at the contribution of the 3 industries to GDP, actually, tertiary industry became the first contributor since 2014. So if you look at the correlation, I think the number is too small, I'll name it out. The correlation of total retail sales of consumer goods growth is 0.93, which is a fairly high correlation. So it means the drivers, the ultimate drivers of China's GDP growth are still those traditional ones: consumption, consumptions, and export. Export has a high correlation as well, 0.88, and the industry production. But if you ask whether the house price is correlated to China's GDP growth, I'll show you the stats. I would say, from a direct sense, no, it's not correlated. It's not driven. It's not driving China's GDP. Actually, when we talk about house price here in the States, we consider the capability of buying houses, which is need. And we also consider supply. But back in China, we only consider needs, because Chinese people do save money. It's less economic. It's more psychological, because they are eager to own land, and China's property market is more like U.S. equity market. It's momentum, but people invest to fight against inflation. So I wouldn't say the house price is driving GDP, but if you look at the numbers on property investment growth, it is highly correlated to GDP, and it's a big contributor. as well as the infrastructure investment, which is initiated by the government. So I would see the stimulate drivers of GDP growth would be infrastructure and property investment, but it's not really highly related to house price. I would say that.
Yeah, I mean, I think it's accurate. I mean, first, as a starting point, I can't think of any large economy in the world at the moment that's not crossing their fingers and hoping for large amounts of infrastructure investment to stimulate growth. And I guess, you know, China played that card back in 2009 and played it fairly aggressively, and I think played it fairly correctly, albeit in hindsight maybe there was overinvestment. But, you know, at the time, what we were looking at in 2009, the level of fiscal stimulus initiated by China, I mean, it was less than what Australia did relative to GDP. And, you know, the housing market, I think, has been a necessary area of growth. Hard to see sometimes, given that the size of development and the level of oversupply often looks insurmountable from the West. But if you think about the need to ensure that there's adequate housing in China, and the ability of financial institutions to provide longer-term funding to real estate companies and ensure that they can maintain that inventory and have it prepared for when it's needed, you're seeing that the housing market is actually is able to work itself out. But I don't think it's going to be the driver of growth in China going forward, as much as the transition to domestic consumption, the continued increased growth in services as households find themselves established and look to and grow in affluence. And I think they're going to be the more interesting areas of growth for China going forward. So we may not return to a period where nominal growth is 12% and inflation's 4% and real GDP is at 8%. We'll probably find lower inflation and new segments contributing to growth. And maybe the 6 to 7 is the new normal for growth in China. But I think we'll see an increasingly diversified source of growth for the Chinese economy going forward.
We could spend several days on exactly these subjects. Thank you both. What we'll do is we'll stop this conversation right here, but look forward to many more with all of you. Thank you very much.
Thank you, Connie. Thank you, Tom.
Thank you.
Thank you, everyone.
Hello, our next panel are just receiving microphones, which is an opportunity in the meantime to see if there might be a question among any of you. Question of John. Yes, Pam.
Thank you. When you say the housing market in China is not correlated with GDP growth, but the price of the housing, especially in the first-tier cities, is very high. Considering if this were a bubble, what would happen to the economy if the bubble burst?
First, I want to address a fact that there is a strong limitation on house buying in those top-tier cities. For example, in Shanghai, the policy only allows the residents in Shanghai, because there's a residence system in China. It's different from, you can move from state to state as you wish. So the residents in Shanghai can only buy 2 houses. The first one, the down payment should be 30%. The second should be 70%. So yeah, it's a very strong limitation. And you cannot buy a 3rd house. You can't. You just can't. I would say, even that's the case, the price of house in the top-tier cities wouldn't fall sharply. That's like common sense, because all the population, the big needs in the cities, that won't let this happen. And in 2nd-tier or 3rd-tier cities, the house price might be going down by large but I wouldn't say there's such a bubble thing in house price, although it's very high because the needs are always there.